Hi, my name is Jeff DeWeese and I am the Chief Investment Officer at Oric Capital Partners. Today we're going to talk about how a downgrade of U.S. debt can affect markets. The U.S. Treasury bond downgrade refers to a decision by a credit rating agency to lower the credit rating of U.S. government debt. This downgrade signifies that the agency believes that the risk of the U.S. defaulting on its debt, even if still low, has increased. So what is a credit rating? A credit rating evaluates a borrower's ability to repay debt. For countries, it reflects the perceived safety of investing in that country's bonds. The U.S. Treasury issues bonds to finance government operations, and those bonds have historically been considered among the safest investments globally due to the government's strong creditworthiness. In fact, in many financial calculations, the U.S. Treasury rate is also called the risk-free rate. A downgrade challenges that perception. For a little recent history on U.S. downgrades, you just need to go back to 2011. S&P downgraded from AAA to AA+, then again in 2023, Fitch downgraded from AAA to AA+. And lastly, Moody's downgraded in 2025 from AAA to AA1. All these downgrades were just one notch. Some countries that still have AAA ratings are Germany, the Netherlands, Switzerland, Singapore, Australia, Denmark, Sweden, and Norway. Why does this all matter? It affects investor confidence. A downgrade can shake investors' trust in U.S. debt markets. It could increase borrowing costs for the government. While U.S. Treasuries are still considered safe, a downgrade could eventually raise interest rates on government debt, making borrowing more expensive. Global markets can be affected as well. Since treasuries are a global benchmark, this could impact everything from currency markets to interest rates globally. It also often sparks political debate about fiscal responsibility and government spending. Mortgage rates are heavily influenced by the 10-year treasury yield. The downgrade could cause investors to demand higher yields. Higher yields on the 10-year leads to higher mortgage borrowing costs. Higher mortgage costs lead to increased monthly payments and may cool down the housing market, especially when combined with already high home prices. Since this was the last of the three major rating agencies to downgrade, an immediate and significant rise in rates is unlikely. As we have seen after the two prior downgrades, the fundamentals, economic and inflation data, as well as Fed policy will ultimately determine the direction and magnitude of yield movements. But at some point, the government deficit spending that has been causing the downgrades will need to be addressed. As always, stay calm, stay diversified, and stay positive. From all of us at Oric Capital Partners, we wish you all a great day.